What's going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. So, typically, as you know, we do a 5 question format where I field questions from listeners throughout the week. However, this week we have a very special episode where we have an interview with none other than Ethan Weitz. We're going to ask him some questions about the market, some positions that he's been in, some mistakes, some wins. We're going to go through everything. So, without further ado, here is the conversation that I recorded with Ethan Weitz this week. All right, everybody, here we are with Ethan Weitz. We're going to do a few questions, but first, Ethan, how are you doing today?
I'm great, buddy. How you doing?
I'm good. I'm excited to have you back. I know it's been a few months since we last had you on. There's been no shortage of news, geopolitics. It feels like there's something going on every day. So I feel like we're going to have a lot to discuss today. Wouldn't you agree?
For sure. I feel like we could do this almost every day with how crazy the markets are right now. So
No,
I'm happy to
no,
be here.
no kidding. No kidding. If it's all right with you, I'll hop right into the questions and then we can go from there and yeah, just have a discussion.
Let's do it. Let's go.
Perfect. So I think my first question for you, where I want to start, and I think this has been sort of in the forefront of most people's minds because it's happened so recently. Walk us through your opinion on software after the SaaS apocalypse, people are calling it, stuff
hmm
surrounding
hmm
AI and Anthropic. What was your opinion on that whole event when those software names got sold off? And did it prompt you to go long any specific names in the group? And why did
Yeah.
you select the names that you did?
Yeah, for sure. Yeah. So in terms of software, I want to say the last number I saw that was roughly $2 trillion had come off. I think just public market valuations in the last couple months. The ETF you and I follow and most follow in software is at IGV, which essentially went from 105, 106, 107 down to 78 a few weeks ago, which in terms of a drawdown is, from what I remember and read, similar to what happened in 2022, where you had IGV, I want to say mid to high 70s, traded below 50 before bottoming as well. I guess this one different because this was driven by Anthropic's Claude basically turning natural language into software, I guess I would say, rendering manual coding effectively useless. That was at least the market response for right now.
Mhm.
Um, there's always something that sounds awful that makes people panic like that. So it's not like, we all felt the same sort of in 2022 when oil went from 90 to 120 and everyone thought it was going to 200. And by summer it was below 90 again. Um, I think what initially got me was the technicals. I frankly, with a lot of these software companies, I don't really understand what they do. Um, but yeah, the technicals were, I think, the big one that drew me in a little bit early, and I think maybe you as well. And I apologize, but was that there was that day where roughly over 70%, I want to say, of all software companies had a RSI below 30, I think is what it was, which is a relative strength index, which basically means they're all extremely, extremely oversold, never happened before, et cetera. The outcomes within a month, 6, 12, or 18, I forgot what they were all very positive after a scenario like that happened. Around that time, we had that day or so around there, we had a midday sort of bottom on huge volume, and it closed. IGV, I'm saying, closed okay. On top of what was going on in software, there was this buy semi short software trade as well that the street had, basically a pair trade. I wasn't involved in it. And that got very wide. And from what I remember, in the 5 months around up to that point, you had the SMH up almost 30% and you had software down 30%. So that sort of how wide that pair trade got drew me in as well.
Mhm.
Uh, and so I put that trade on, basically buying some software and shorting some SMH. But as I said, I'm not super in touch with what these companies do, and my understanding is minimal. But so my goal was waiting for, a company to increase a buyback, or insiders to start purchasing stock. That's what I was looking for,
Mhm.
to get me, to start to size into a position a little bigger. You're starting to see that now. It's drips and drabs. But we had CRM, which I think is very intriguing. Again, I know they own Slack. If the software was sent to me, I really wouldn't even understand what it is, I'm sure. But they announced a $50 billion buyback on roughly $180 billion market cap. So, I want to see these names start to act well with a reason behind it. Synopsys, which this SNPS, you traded great a couple of days ago, accelerated a $250 million purchase. The ServiceNow you saw me in. Their announcement was not from I guess the executives stopped making sales in their stock plan,
Mhm.
which was positive. And then I think that same day you had the CEO buy $3 million, maybe roughly $3 million worth of stock.
Mhm.
You've had CRM management start to get involved, insider buys there. You had Microsoft a little bit. You had Sentinel One. And I think you had that Klaviyo, that KVYO.
Yep.
So I guess that's from my standpoint. I was there a little soon, and then once it turned back to above my cost, I got a little bigger, and those are the names. And I guess that's kind of why.
Gotcha. Gotcha. Okay. So, and you mentioned briefly the pair trade semis versus software. So I want to shift gears a little bit and talk
Mhm.
on semis a little bit. Now that we have the NVIDIA quarter behind us, given the report and the tidal wave of news releases since we last had you on as it relates to semis, NVIDIA, AI in general,
Yeah.
has your short thesis or opinion on NVIDIA changed at all or remained the same? Or can you give us maybe like an update on your thoughts?
Yeah, I'm happy to, because it takes up a lot for me, and frankly, not as big a portfolio name, but more just because it's so topical always. And I'll tell you, my thesis has not changed. Maybe I've adapted to a couple new pieces of news, but I will give you, I'm still short. And I had chances to cover lower and I didn't, and then the stock went up 20% after that, and has since started to break again, or at least come back in. I don't know if it's broken. It's the quarter was great. I think they did roughly $68 billion in revenues, and I think for the following quarter he guided 72 to 78, which is just obviously insane. I think it's 70% year over year revenue growth. It's mind-boggling when you think of it, and it's the reason it's a $4 trillion company.
Mhm.
That being said, that's no surprise. We heard obviously from the hyperscalers in the last few weeks that CapEx for this year is going to be roughly 650 billion, on top of the 450, 475 from last year. Again, we know this stuff. So this is, NVIDIA was reporting into news in my mind that the street knew. And the stock responded like that too. Obviously
Mhm.
came for sale and came for sale aggressively.
Mhm.
The reason I'm still short is the following. As of right now, NVIDIA is cheaper than Coca-Cola. And I like that because the market is finally starting to discount, I think, CapEx decreasing in the out years.
Mhm.
And that's something I haven't seen before. And that's where I want to be. I'm not pressing. I'm not getting bigger. It's a dollar-wise a good enough size position. I'm going to stay there. And I'll tell you what sort of confirmed that for me. I'm going to butcher it, but on the conference call, one of the I think it was the Bank of America analysts asked Jensen about NVIDIA's ability to grow even if the hyperscalers don't continue to grow CapEx, which I thought was a great question.
Hmm.
Um, and he answered basically saying that he was confident that their free cash flow would continue to grow, and followed it up by saying something like, because we were at some inflection point of agentic AI and usefulness of agents. I forgot what the specifics were, but that's just not true. That's 100% not happening. You can call it a lie or you can call it an exaggeration, but in the last 3-4 weeks, the top four hyperscalers have basically reported their earnings. Their free cash flow metrics have collapsed. It's the reason the stocks have come in.
Hmm.
Um, Amazon, I think free cash flow was down in the 70 percentile, 70%. Meta was down 12, 14, maybe I think it was 15%, maybe more. Microsoft had free cash flow down 8 or 10%. Google, I think, was flat. So that's just not true for him to say on a conference call. So something like that, again, it's a 4 trillion. There's nothing fraudulent about this, but I don't know why the promotion needs to continue.
Hmm.
I guess what annoys me more is after that, I think the Bank of America analysts actually raised the price target. I want to say from 250 to 300. So it's frustrating, and I feel sometimes like I'm definitely a minority on this one. Yeah, so NVIDIA, I'm still sure. I guess I'd say one other thing if I can.
Hmm.
I think he's an awful allocator of capital as well.
Jensen.
I think Jensen is not a good steward of NVIDIA's capital. Here's why I'll tell you. And I can talk about this. We'll get to the next question, but let me just give you sort of in general.
Please.
He just put in $2 billion into Lumentum, which I think a symbol, LITE.
Hmm.
He put in $2 billion into Coherent. He put in this number after Lumentum was up 1,000%. He's not putting in that money for an investment. Same thing, Coherent. It's not why he did it. He did it because obviously he's getting the business back, or in some way trying to continue, in some way affect, I think, the supply chain in a positive way. And he did something similar in CoreWeave, which, if you remember when CoreWeave priced March, April last year,
Yep.
they needed NVIDIA to come in. Well, it was a tough time with the tariff stuff, but market came in. They needed CoreWeave to price. They needed NVIDIA support for CoreWeave to price.
Hmm.
Recently, I think in the last few weeks, CoreWeave went to price $4.5 billion for a loan with Blue Owl. And I think, again, NVIDIA need to get involved. And again, I want to say wrote a check for a couple $2 billion. I could be wrong. To give you an idea, CoreWeave is just basically an equipment renter. However, I know that sounds silly, but that's basically what Chanos's thesis has been, who I've read and respect. And that, in my mind, that means the following. They're not making money. The revenue number's decent size, but I think he put out a piece saying that even if they took depreciation out to 12 years, that CoreWeave still loses money. I'm not making a case against CoreWeave. I'm making a case against, I want someone to explain to me, if I'm Jensen, hey, listen, you're allocating shareholder money. I know your margins went from 70 to 75%. I would argue some of those are probably not. Those are probably some of these private companies that don't really care about price that much, and that's where you're getting some margin expansion. But I just don't think you're allocating capital right. So there's a couple examples there. I could continue, but it sounds, I feel sort of defense, always like I'm defending myself in the NVIDIA.
Effectively, and correct me if I'm wrong, what you just said about Lumentum, Coherent, CoreWeave, this is effectively no different than NVIDIA, Amazon, and anyone who's making their own chip participating in OpenAI's latest round that they're trying to raise money at whatever it is, 800, 850 billion. It's the same sort of deal kind of thing.
Exactly the same thing. Exactly the same thing.
Mm-hmm.
That's right.
Mm-hmm.
So, and again, from my standpoint, I know in a $4 trillion market cap, these numbers don't matter, but they might one day. But it also shows me other things of how he thinks.
Right.
And I just, you and I've, we've talked about the, how important the, ROIC is, and some of the great compounders, from an investment standpoint or from a CEO standpoint. It's just the exact opposite of what you're supposed to do. So that's, I'll leave NVIDIA after that.
I think my next question for you, I know we obviously just this past weekend got a ton of news regarding the U.S., Israel, Iran. Maybe outside of that, because that just happened, or if you want to talk on that as well. My next question for you was, with the S&P struggling at 7,000, struggling to break out, and it feels like the next move is lower, what are some of the risks that this market faces, biggest risks, whether they're geopolitical, macro, micro, what are things that you're watching or maybe anticipating that could be the next thing that breaks this market, the straw that breaks the camel's back, so to speak?
Yeah, I've thought about this, but I haven't thought about it with regard to geopolitical, because I think I've told you before that always ends up being something where I sort of trip up and ends up being shorter term than I think. Again, this morning on the opening, it felt like we were going to test the 200-day, which is like, let's say, almost 6,600 in the S&P. We obviously bounced very quickly, but to me, geopolitical is tough. But I'll tell you, where I sit in terms of valuations and why I'm not comfortable in this market, and a lot of names in general on the long side. I think the S&P's trade, let's just use the number 25 times forward earnings. So something right off the bat, it needs less of a catalyst than if we were at 18 or 20 times earnings. No different than software was trading at 35, 38 times EBITDA when it started, and now, gets cut in half. So expectations obviously come in. And so news reflects itself, and you can, from that standpoint, I think there ends up being less cushion, and you have a lot of negative stuff starting to get built in when you get an 18 times you got a 25 times forward earnings right now. Here's where I think the S&P today looks a little similar to 1999, 2000. And again, everyone's comparing it and saying it's wrong, and it's the first thing people do when they see a bubble. Let's go back to the last one. So just for perspective, the market peaked in, let's say, March of 2000, and I'm going to use the market cap to GDP ratio as my indicator. It was roughly 140%, and now market to GDP is roughly 210%. People will say, no, it's a much different economy now, et cetera. Just to frame it, at that time, we had $5 trillion in debt and roughly, I want to say 10 or $12 trillion in economy, in GDP, excuse me. So just to give you an idea of how we got to where we are. So the thing that I think is important in that number is the market cap to GDP does not include private companies. In 2000, the venture capital industry was, I don't remember it. If it was there, it was very tiny. And today's very different. There's always discussion about Cisco peaked in March of 2000 at, I want to say 80, 90, 100 times price to earnings ratio. And they said, well, NVIDIA is trading 20, 25 times PE. But I don't think NVIDIA is the poster child for this market or for AI. I think OpenAI is. And here's my thinking. You've heard it, but I'll belabor it for a few minutes. OpenAI just raised money at roughly $840 billion with a revenue run rate of, let's just say, 20 billion a year. We'll give him another couple billion. We'll give them 15, 20%. So let's just use a number of 25 billion in revenues. So as of right now, OpenAI is trading 35 times sales on a forward basis. That's 2026. SpaceX for 2026 is doing roughly $15 billion in revenue. So let's give him another 5 billion. Let's just say he's doing $20 billion in revenue. That's on $1 trillion valuation. So it's 50 times sales. Okay. Mm-hmm. For reference, Cisco peaked at roughly $500 billion, give or take. I'll be wrong. When revenues were 20 billion ish, which is basically 25 times sales. Sun Micro peaked at $200 billion valuation. You remember the Scott McNealy dialogue of how I'm going to get money back to shareholders. At that time, I think revenues were 20 billion. So you have 10x sales there. Nortel, a name you probably know, was Canadian, peaked roughly $250 billion and 25, $30 billion, 8 to 10 times sales. My point is this: Cisco Sun looked cheap compared to the present day silliness. Okay. So just as a sort of really important to have perspective here, not just today or last week or last month, but just for history's sake. So what I think trips up the market probably happens in the private market. OpenAI just raised, it was $110 billion, right? Mm-hmm. Basically from their supply chain. Okay. There was no financial guys in there. There was no hedge funds. There was no long only guys. I think that's important because they usually obviously help with price setting, opposed to Amazon, who says, I'm in for 50. They commit 15, wait for the balance. I think until there's AGI or until there's an IPO was the other 35. But that's not, doesn't help with, is it truly worth 840 billion? Just again, for in terms of big numbers, if they raise 110 billion, I think was the number we said, that's basically Blackstone that they raised. It's crazy and it's huge, but think of what that is. It just, it's like, for me, whatever, you raise the entire airline industry. I think United, Delta, Southwest is 100 billion. So where I think where OpenAI runs into a problem, and I think the market does, is when they go public, CapEx gets cut a tad, and now you have public companies where managers are very discriminate about how they allocate capital, not someone in the supply chain. So that's sort of my thesis. I don't know if it happens before with the SpaceX IPO, but I think that that's where things maybe change for the NASDAQ and for the S&P. I'll say one other thing now that I'm thinking about, if you don't mind.
Yeah.
The rotation we're seeing is very similar to what we saw in 2000, meaning rotation from tech to consumer staples or semis into utilities. We saw that in 2000. We saw that in 2001. We didn't see risk off completely until 2002. So this is very natural from my standpoint in terms of what sort of sequentially how we go through this process.
Okay, so you're saying there's still time for things to come undone.
Feels like it, but we've been saying that for a long time from where I sit.
Okay, well, let's move. I mean, I do have one more question for you later that we'll go back to some negative stuff, but let's go to something positive.
Oh gosh.
You had some great trades in some media stocks over the last few months. Can you walk us through, give us the thesis, your thoughts on Charter, Versant, VSNT? What was the thinking behind these names? Was there any, one data points that really gave you the conviction to say that this is, a great call and I want to size up, or was it a culmination of things? Just walk us through those two trades, because I know those are two big ones.
The Comcast or Charter. I can talk about.
Oh, sorry, maybe sorry. Or you can go talk about both if you have
I
stuff to
think
say
the
on both.
Comcast one was just. I was in it a little longer, and it has worked. Charter hasn't worked yet. I'm happy to go through that as well. But
Mhm.
the Comcast started off as a year in name that you remember, and fundamentals kind of improving. And I was thinking that the flows from a, you know, selling tech to buying sort of a little bit more stable names might occur as well. Again, it's basically a no growth name. The cord cutting story is not new. It was just for me more a function of less bad.
Mhm.
Um, and that November quarter, you and I spoke about it. You were on top of it. There was a nice reversal where finally the numbers started to look like they were not going to fall off a cliff, and some analysts could finally model the fact that okay, fine, things are improving here from that standpoint.
Right.
Um, it was trading at roughly 4 times cash flow. And my thesis at the time was also them walking away, if you remember, from Warner Brothers. That really didn't happen. I mean, they did walk away, but they didn't really even get involved. Um, and I like to see the fact that the hyperscalers were coming for sale, and these cable names and some of these stable names were starting to work. And we got, so that was the reason I was there. And I think the reason it worked. Charter reported after Comcast and basically also laid out a really nice game plan for CapEx going down, starting to buy back stock, increasing free cash flow. And what's happening with these cable companies, which I think is interesting as well, is you're able to now bundle for cheaper than if you go to Apple TV, able to bundle, able to get HBO Max for cheaper, and Disney, ESPN, et cetera. So they figure it out now, and it's helping. Their numbers are improving there. Specifically, Charter, Comcast as well, but not as much yet. But the stocks started to reflect that and started to bounce. And then my thinking, so the Versant story is, I could talk more on Comcast, but that's basically what happened. And we got a nice move from 26, 27 to 32, 33. And I made some sales. I'm still there on a small piece, but very small. Yeah. So with Versant, I knew nothing about the company, frankly, before the spinoff of Comcast. The Comcast deal was for every 25 shares of Comcast, you get a share of Versant. The first trade I want to say was in the win issue was in the mid 40s. And it most if you own it, once the spinoff happens and you happen to be an indexer, let's say, you have to be out of the stock. So the stock went from mid 40s to 27, 28, pretty fast in about a couple of months. Not much volume, and then started to pick up in the last few weeks. Versant's basically CNBC, MSNBC, I think USA Network as well. It started to act better, and when I say act better, I had a few days where it closed on highs, sort of ignoring the market. I like to see that. For reference, the cash flow of Versant, let's say 2.5 billion on a market cap now, or the last few weeks of 6 billion. I think, which is, let's say 2.5 times, extremely cheap. That doesn't mean anything, but it's cheap. The catalyst that woke me up a little bit to the name, because I had just basically got this tiny amount from Comcast. So I'd looked at every so often, but it didn't really matter, was insignificant. But I started to get more involved in a decent sized way when I saw Diller interested in CNN. And I was thinking, if that could happen to CNN, my guess is something like this might happen to CNBC, where you see someone go after CNBC at this price. It makes sense. And then I was sort of putting together with, in the background, this administration it would be very friendly to something like that as well. So I started building a position. It went up pretty quick. And I sold most of it, and I bought a lot back today. They announced their earnings. They announced basically buying back 20% of their stock, which is a pretty big number, on top of a 35 cents ish, roughly dollar 4% dividend, a little over 4% dividend. So that's those two names. I know nothing really more about cable than that, but that's what got me involved.
Nice, nice. And let's also not forget about CAVA, CAVA.
Oh
That was
yes,
another great
yeah.
call of yours. So walk us
Yeah.
through that one. Similar thinking. When you what was the thinking behind that long when you started to put it on? And can you comment a little bit maybe on the mental framework for when is the appropriate time to start trimming a winner? Because I think you did that one pretty well, right?
Yeah, I'm worried though if you've hit me with these winners, I'm going to get run over with the losers shortly. So let's get past Kava quick. But yeah, I'm happy
Okay.
to tell you that did work. Here's my thinking in
I'll knock
Kava.
on wood. I'll knock on wood real quick.
Thank you. Here's the Kava was group was decimated in the year. Shake Shack, Kava, Chipotle, obviously Sweet Greens. Labor costs up a bunch last year, less eating out, maybe even GLP-1 exposure or people sort of cutting back there. The catalyst for me at that point, believe it or not, I thought was Mom Donnie winning in November. And I'll tell you why. His whole thesis was effectively affordability. And I was I was very surprised to see how Trump embraced him rather than went after him after he won. And I think he embraced him because he realized that that's a big concern for the American people right now,
Mhm.
which is how do I make stuff more affordable, period. And again, it lined up with a bunch of year-end selling that I like to see, which tends to be forced. And then obviously with tax refunds coming up in April, May, that's sort of a big deal for the consumer, but also how Trump was starting to position, as was Besant, ahead of the midterms. Let's focus on affordability, and I think they took that from Mom Donnie. Kava specifically, small company, $8-10 billion valuation. I think from what I remember, I'm not there right now, but they opened 70 stores a year. I think they had got to 450, and the goal was to get to 1,000 by 2030, 32, I think. The reason I liked it's interesting, and it's good to realize, because when I look back, it's exactly why these other names didn't work as well. When these names were getting sold for tax reasons, Kava was one of the few where same store sales was still up 3 or 4%, in some cases 5%, which just means stores that are open for more than a year. So despite the fact the name was getting beaten up, the fundamentals were still okay. I bought it really well and sold it really poorly. And when I sold it, I realized I needed to buy it back, frankly, because the story hadn't really got out there yet, and the stock had a lot more upside given where it was in the last few years. So that's a perfect example. As I said, that happened this morning as well, where I think thesis in my mind had not yet. I was staring at the stock and I was happy to make, I think it moved 5 or 6 points, and I got out and I thought it was terrific. And then I realized that there's a bigger trade here. So the reason was because the fundamentals were improving. And that's what kept me there. And then they reported a good quarter a couple of weeks ago. I got stopped out. You saw just disgusting and Sweet Green. I was long a lot of that. That hurt. Chipotle did fine. Shake Shack, excuse me, did well. But Kava was the one that I held for a couple months and did okay. So yeah, that's Kava.
Could you maybe comment on why you think Sweet Green was the one that lagged the group?
Sweet Green was lagging because. So initially, I thought it was because there was a bankruptcy in the high yield. It wasn't the case, but there was in the high yield market, there was a bankruptcy. And I thought, gosh, is that somehow affecting this? I thought it was maybe then as you know, I walked into the Greenland thing with a lot of these positions. It did not bounce back. I was like, is there some tariff in Europe on some input food costs? I couldn't figure it out.
Hmm.
At the end of the day, their business isn't great. It's just not. And I personally like the store. I go there frequently. But when you start to look at their quarter, it wasn't, it's below expectations. And they are competing in a $15, $17 per dish market. And I think you've seen Chipotle make some changes to get to, you could basically buy a protein for cheaper was, I think, their goal. And CAVA is more Mediterranean, so sort of not apples to apples. But in hindsight, the fundamentals were deteriorating. It wasn't tariffs. It wasn't the bankruptcy in the high yield market. And it hurt. I stayed there longer than I should have. One, because it's a more liquid name, so I could buy more, but I get run over more as well. And that's yeah. So I think that's the reason.
Okay. So, as much as this pains me,
There
we've
we
talked
go.
about
You
we've talked
go.
about a
I knew
few
it was coming.
we've talked about a few winners.
Yeah.
Now I think we got to get to the very, very valuable part of this podcast, this episode, and we need to talk about some losers. And the one that I
Okay.
want to bring up is unfortunately AMD, and
Oh, okay.
specifically regarding
I have one.
AMD. When
Right.
you were short and the stock goes against you the way that it did, just walk us through what's going through your head, what's your game plan, what's going on, and just talk a little bit about the trade there.
Yeah. Good. Yeah. AMD. There's another one that I'm happy you didn't bring up, but maybe we'll talk about that later.
Okay.
The AMD one is so the reason I put on AMD in the first place is I wanted some short exposure in the market, and the chart was starting to fade, and I wanted to be there before the quarter. Sort of not really great reasons, um, and I think I was right for a couple of days, but it went wrong real quick after that. I think I cut half of it on the way up. I want to say you could remember better than me. I think I made a 208. Essentially, sale went to 203, 205, and then basically up to 240, I think, in a straight line, 235, 240. I'll tell you one of the things that has always sort of helped me when I make a mistake is when you make a really bad mistake and you sell the low. I think there's nothing more valuable than knowing that, and I'll tell you why. Because I kept saying to myself, when it gets back there, if it does in my lifetime, when it gets back there, I'm going to get real big and get real short at that price again, because I knew I sold the low. And if it goes through the low again, I think that's a great indicator of the fact that the stock's got a lot lower to go.
Mm-hmm.
So that's what happened. It wasn't a great reason to be involved on leg one. The cover, I should have covered the whole thing. I didn't, so I suffered on the other second lot. And then when we finally got that turn a few days before the quarter, and basically the semi narrative had shifted, they could have almost said anything in the quarter. It wouldn't have mattered. If you remember,
Mm-hmm.
semis were for sale.
Mm-hmm.
And then I re-engaged and got short again. And yeah, and ended up doing whatever. I don't think I ended up making money, but I lost a lot less than I was about to lose. So that's yeah, but that's AMD.
Okay, so that's AMD. This next question I have for you, it's not something I think that's being discussed in the market a whole lot,
Mhm.
if at all, really. I mean, I wasn't even paying attention to it until you kind of brought it up to me. But now I want to ask you and get your opinions and thoughts.
Okay.
What are you thinking is going on in the life insurance market as it relates to private credit?
Yeah.
Like I said, I don't think it's talked about anywhere really in the media, and I think it'd be valuable for our viewers to hear your opinion and what you think is going on there.
Yeah. So, yeah. Thanks for asking. I'm actually The first time I picked up on this was a Bloomberg article. And I looked at the charts and I was like, this is weird. Why do they look like this? What's going on? And started to do some digging. And I'll say sort of the top line stuff, which we all know, which is the private equity guys own a bunch of insurance companies and they've been buying them for the last 10, 15 years. I think the idea was sort of similar to what Buffett did, which is we're going to use the float of premiums paid by people who want insurance for investment.
Right.
And so Apollo bought Athene. They actually spun it off. They rebought it. KKR owns, I think, Global Atlantic. Brookfield, which also a big one based in Canada, but also has exposure in the U.S. They own some American National, I think is what it's called. And the idea behind insurance companies is the float that, as I said, that the insurer pays is supposed to be invested in corporate bonds, cash, and Buffett's case, stocks, but that you don't sell long term, that are, I guess, safe, conservative. But what's happened is a little different now. So you have, just for sort of perspective, the private credit market, I want to say, is, you've seen it, let's say $1.5 trillion, maybe as much as $2 trillion. These private equity firms are starting to transfer their deals where they put together a private credit deal onto the balance sheets of these insurance companies. And one, it's illiquid. You're not buying treasuries, you're buying private credit. And two, it's not arm's length transaction. A lot of them are being done. So it's basically captive. And they're doing a lot of these in Bermuda. This is not new information, in the Caymans, et cetera. But so that's kind of where I started with, just that doesn't pass the smell test, which it can work fine. And private equity guys are extremely sharp, extremely sophisticated, and they can be making great loans to these insurance companies. But what got me short some of them was the fact that 20% of private credit is software loans, a lot of CLOs. And some numbers are, I've read, even higher, 30% maybe. It's a huge amount of private credit in software. So obviously, with what's going on with software, nothing's happened yet, except for they've gone down a lot. No one's missed payments. You also have a lot of these insured mom and pops who pay premiums are seeing this float invested in, I guess, data centers too. That's also part of it. And whether they care or not is irrelevant. And I'm sure they will all be fine until CapEx gets cut and data centers don't generate the 12 or 15% they're supposed to. Or you have a mismatch where a lot of these private credit loans they went from being in institutional ownership hands, which is pensions and long-term evergreen mutual funds, et cetera, to retail. And if retail ever wants their money back and these private loans are sitting there, you could have a situation where you have some dominoes start to fall. I guess on top of the fact that the economy, if it slows, which I know we've seen a couple of these credits default in the last 6 months, not many. That sort of turned me onto it and got me concerned, is where I started putting some of them out. You look at the charts on even Equitable, MetLife, Lincoln. These are insurance companies, and a lot of them have leverage, offshore as well. It's one of the reasons they go to the Caymans of Bermuda. So that's where I got concerned. And I think it's a way to be short the private credit market. And you could have, as I said, where these are very liquid investments and they've worked great because we've been in a bull market, and they've paid off. And yes, if you're a private equity guy, you'd say I'm an idiot because instead of buying corporates for 4.5%, hey, we can get a software loan for 12 or a data center loan for 12, 15, whatever the numbers are, plus a few points. So that's happening. I just don't think it lines up. You have, from an analyst standpoint on the sell side, guys who are covering these private equity firms don't read insurance companies' balance sheets. That's very different. There's a mismatch there too. So yeah, those are the things that concern me, and more than you probably wanted to hear, but insurance.
One follow-up question regarding that. If I'm not mistaken, there's no government or federal
That's
backstop or
right.
mechanism to prevent when something breaks. I mean, they would have to step in and
This
solve
is
something similar to '08. It wouldn't be, there's
this
no
is
infrastructure, there's no insurance for something like that, kind of, really.
so you can have. I mean, that's a great point. That's the last thing I would have said too, which is, if you do have people who have life insurance and they're in a situation where they potentially can't get paid and it's not money good, that's very dangerous. That's absolutely what the government will step in. Again, the government will not look here until there's obviously a problem and so there is no regulation over offshore. And as I said, so that's my thinking in the insurance names. And again, if we continue to be in a bull market, no issue, but something to keep an eye on.
Right, right. If something breaks, then the dominoes fall for sure.
For sure.
Okay, so I think final question for you here, Ethan. I don't want to take up too much more of your time. Are there any other positions that you haven't mentioned or we haven't spoken about here, or I haven't asked you about yet, that you like so much, or positions that turned out to be good lessons from the past few months that you think would be valuable to mention on this podcast? Maybe something that I missed. Or is there anything else that you think the viewers should know?
So a position that I guess what I'm looking at where I haven't gotten bigger yet, I can give you one of those if that helps.
Sure. Yeah. Yeah. Please.
Where I'm small in, and we've talked about it, you've seen me involved, is the Kraft Heinz.
Mm,
The symbol's KHC. I will get bigger. I'm not yet. What got my attention in Kraft Heinz was initially the new CEO announcement January 1st. It was a guy from Kellanova that orchestrated a really nice sale to Mars at a tough time for a consumer staple at roughly 37 billion. I forgot the number. And so him joining Kraft Heinz, along as well as with the fact it was a name that had gotten beaten up real bad last year. I didn't have a fundamental reason though to buy it. And they were splitting into two. That was talked about for a while. And then Buffett, I think, announced, or someone from, I don't know if it was Abel or Buffett, announced that they'd be selling their stake because of the spinoff plans. I don't know if they said because of the spinoff plans or they'd be selling their stake. And their stake is roughly 27% of the company, which is on a billion to, it was 300 and some odd million shares.
wow.
The stock came in hard on that. It was no surprise to you and I. They've been talking about doing that for months. So I got involved there. And then they announced, the CEO announced after, they're not, let's say a month or two after, that's not true, probably 3 or 4 weeks after, that they're not spinning into two. And at the same time, Buffett announced, or Abel, I should say, announced that they're not selling their 300 million shares. And this, I almost feel like it hasn't been noticed. Consumer staples have had a huge snapback, or had a huge run, not a snapback. They've outperformed mostly all of tech in the last couple of weeks, just with the sell tech by Staples trade.
Yeah.
But I feel like there's more in this name. It pays a little over 6% dividend, which I think is for 160 a year, $1.60 a year. and it's covered. They do about 2.5 billion in free cash flow, and the dividend, I think that's about $2 billion dividend payment. So, yeah, that's my thinking there. Management, valuation. I don't have a crazy catalyst. Money flows at this point are not my catalyst, because staples to me have become over talked about, and everyone wants to be in the staples trade. I think they probably, I think it'll be a good trade for 26, but short term, we've seen staples show a little bit of weakness. So, but yeah, I'm there, and I'll get bigger.
Awesome. Awesome. Before we end the episode, I do want to ask you, tell us what went wrong in Morgan Stanley.
Yeah, I knew that was coming. Um, Morgan Stanley was an awful, awful mistake, and it was 100% emotional mistake trading. I don't remember the name that I was involved in before Morgan Stanley, but something got me into this. I need to go get back what I just lost mentality, which is just very immature, very sort of not professional trader mentality, but it hit me hard. And Morgan Stanley had sort of a few average things going for it, none of which I would normally care about. One is great earnings, gap to all-time highs, trading 194, 195, probably goes through 200. Nothing, not a real story. And for someone who wants sort of not to have much long exposure in the market, that is not the right name to have. If syndicate slows, if markets slow, if private credit's an issue, obviously, as you've seen, then that's where they're going to come. They're going to hit that name. So they hit the name, and they hit it for a long time. And there was a couple moments where I made some sales along the way on a rally, but it went basically from 192, 193. I think that morning following, which I think was a Friday, I think I was maybe up a buck or two, and then the rug got pulled, and that was it. And we had a long way down, and that was Morgan Stanley. The only reason, again, for me, it's also ironic because I make these mistakes in front of you. So the idea is your trading is so much more disciplined and has so much more meaning in terms of why you're doing things. And you see me do this. I'm supposed to be the one who's not doing the stupid crap. And I do literally something as if someone just opened a brokerage account and said, "Hey, go trade, idiot." And and so you're like everyday regimen. I'm like, yeah, you got to do it like this, but you got to do it like this. And then bam, Morgan Stanley. Why? What are you doing? And I paid for it. And then I don't know, maybe we got it back. It took a little while, but that's
We always get it back.
Stanley.
Always get it back.
Shame on me. I always get it back, but shame, buddy. That was embarrassing and also costly.
Well, I won't ask you about no more losers. I think AMD and Morgan Stanley were the two, and Sweetgreen. We covered those. You know, we were what's it, modest, humble. We talked about the losers as well as the winners, so we have to do that on this show. Sure. I've got no more questions for you, E, but thank you so much for coming on the pod again and walking us through some of your ideas. I think there's a couple great insights there, and it was made for a great episode. So thank you so much for your time.
Pleasure, buddy. A pleasure. We'll do it again soon.
Thank you so much. All righty. Well, I'll let you go. Have a great afternoon, and we'll talk soon, okay?
Thanks. You too.
Thank you, buddy. Bye-bye. So, folks, that wraps up our interview that we did with Ethan. I hope you got a ton of value from that. I know I learned a couple things. I thought that conversation went really well. So, Ethan, if you're watching this, thank you so much again for your time. And we look forward to having you on the show once again very, very soon in the future, hopefully. For the viewers, go check us out on TikTok, on Instagram, and on YouTube. This episode will be posted Friday, 8 a.m. And remember, if stocks go up, stocks go down, the market goes all around, but always that makes 0 sense. Take care. I hope you have a great Friday and a great weekend. I'll catch you on the next one. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.